welcome all our esteemed paper presenters, chairs, discussants, and all participants to session 2C on capital markets in the changing context. The session will be chaired by Jinesh Panchali, and we have Jatin Trivedi as the discussant. Now, I would like to take the opportunity to introduce the chair and the discussant. Dr. Jinesh brings more than 30 years of experience in academics and consulting domain. He currently operates a proprietary firm, Arham Advisors. It offers services in area of governance, mergers and acquisition, valuation, and markets. Jinesh is an MBA with specialization in finance, PhD in management from Faculty of Management Studies, the MS University of Baroda, and a cost and management accountant from Institute of Cost Accountant of India. He started his career with Department of Management at South Gujarat University as a lecturer. He has served Indian Institute of Capital Market, which is now merged with National Institute of Securities Market, from 1995 for more than a decade, including serving as a dean. He has also served as a senior vice president at Financial Technologies Group and its knowledge management subsidiary. Dr. Jatin Trivedi works in the accounting, finance, and banking area, School of Securities Education, National Institute of Securities Market, Mumbai. Before joining back NISM, he has worked as a nodal officer for Queen Mary University of London, UK. Its program with Amity University at 5 country campuses, and also positioned as nodal officer for Presidio Graduate School, Seattle and San Francisco, United States campuses. He has earned Finance Guru title and several awards for excellence in teaching the core courses of MBA graduates in his teaching journey for over 20 years. He holds prestigious membership such as Indian Accounting Association India, Finance and Accounting Professional London, Chartered Financial Analyst Network, New York, USA. He has also established over 40 papers in reputed journals. His paper has been presented in prestigious European and American conferences, including Harvard conferences. He has worked as a reviewer for Journal of Sustainable Finance and Investment, etc. Before we begin the session, let us go over the guidelines. A total of 15 minutes will be allotted for the paper presentation, upon completion of which a bell will be rung. Post this, 2 minutes will be allotted for the presenters to conclude. This will be followed by 7 to 8 minutes of discussant remarks and an additional 5 minutes for Q&A. I would now request our Honorable Chair, Jinesh Panchali, to take the session forward.
Thank you, ma'am. And I think the paper presenter is waiting. So without taking much time, can I request Ms. Bharti Singh to present her paper?
Good afternoon to all of you. I hope you are able to see the screen.
Yes.
So should I start?
Yes, please.
Yeah. So good afternoon to all of you. First of all, I am thankful to SEBI and NISM for giving me this opportunity to present my work. I am thankful to all of the participants as well as the professors and audiences who have taken their time out to attend this presentation. My name is Bharti Singh and I am a PhD candidate in finance and accounting area. I am Ahmedabad. This paper has co-authors as my guides, Professor Naman Desai and Professor Ajay Pandey. My paper title is Efficacy of Surveillance Action and its Relationship with Earnings Management and Corporate Governance. This is the outline of the current presentation. Now I quickly move on to two of the definition that what are the surveillance measures? So surveillance measures are taken by the security markets regulator to detect instances or pattern of market manipulation. So the surveillance measures could be explicit. With that mean that the criteria for putting under surveillance is publicly made available, while they can also be implicit, where it could only be conjectured that what the surveillance measures have been put in place. So why the surveillance measures have been important in the recent years. This is because there has been an increase in participation of retail investors in Indian financial market, which is primarily driven by the lower interest rate offered by the savings banks. So this is the one of the news item which we did encounter, where the news says that the BSE has brought 109 firms under the surveillance, enhanced surveillance. So the article does suggest that their move was primarily aimed at checking any abnormal increase in stock prices that is not commensurate with the financial health of the companies. So we too did ask a similar question. Could it be possible that a repeated surveillance action is linked to the poor financial health of the companies? These are the surveillance actions which are in existence by the National Stock Exchange. Among all the surveillance actions, which in the current paper we are talking about the clarification in case of spurt in price or volume. To give you a glimpse of what exactly it is that if a firm has witnessed any abnormal increase or decrease in price or volume, the NSE sends a notice to the firm, and simultaneously it makes this information to the public as well. The concerned firm commonly replies as that they do not have any material information, including impending announcement, and hence they are not aware that why their firm has witnessed any abnormal increase in price or volume. But there are sometimes a firm which actually does specify that there are some of the relevant news which are impending, and that could be the possible reason that why the stock market is seeing a witness in price or volume. For example, this is a example from the UTV Software Communication Limited, which suggests that they have an impending game launch and they have a upcoming release of the movie. Now, I would like to draw your attention to the another fact. This is the SEBI's. This is the cases of the market manipulation and price rigging which we have extracted from the SEBI's annual report. Apart from these cases of the market manipulation and price rigging, there were the other cases which were related to the insider trading, takeovers, issue-related manipulation, and violation of the securities law, like prohibition of fraudulent and unfair trade practices, PFUTP, substantial acquisition, and share trading. So we want to highlight that in all of the cases, the most of the action that were taken by the SEBI in this regard were the prohibitive direction under Section 11B of the SEBI Act, which actually meant that certain kind of the participants are not certain kind of the participants are debarred for a certain period of time. And who were these participants? These prior participants came out to be mostly the stockbrokers or the promoters or the stockbrokers which were acting in accordance with the promoters. Thus, combining all the three information related to the price manipulation, which were driven by the promoters or the stockbrokers and the financial health of the firm, and the surveillance measure, we put our broad research question as supported by the literature that whether the promoter's involvement in surveillance action and the firm's earnings management leads to any association between the two. And hence we put our first hypothesis as that there is a positive association between firm facing the surveillance notices and the earnings management. In a similar manner, we tried to find the association between the corporate governance practice and the surveillance notices. And we did put our second hypothesis as there is a negative association between the corporate governance characteristics and the surveillance notices. What is the significance of our study? So this is the first study which examined this relationship between the surveillance action with the earnings management. In the literature, these two strands of the literature have not been connected so far, which we are trying to examine through the involvement of the promoters. And we also see that there is a negative cumulative abnormal return in the stock market when the firm faces the surveillance action. So this in a way does suggest that yes, after the exchange takes an action, there is some stock market activity when the firm is put under this surveillance. We also say that there is a positive association of poor corporate governance and the likelihood of the receiving notices. So there is a bit definition of the earnings management, which here with the earnings management, we are talking about there is a purposeful intervention in the external financial reporting purpose with the intent of obtaining some private gain, as opposed to say merely facilitating the neutral operation of the process. So this is the overall positioning of the literature. We are talking about the promoter's involvement leading to price manipulation. Then we are talking about the literatures related to the stock prices and earnings management, and literature related to the corporate governance. We are simultaneously talking about the literature which have only dealt with the surveillance measure, and we are combining the two to find out the where we are positioning our study of surveillance measures and earnings management. So I am actually skipping the literature review in the interest of the time, but the literature overall does suggest that why a promoter would be involved in an earning management practices. What are the motivation for it, for him or her to do so? So the primary motivation was actually meeting the earnings target or stock market or the stock market reaction to the discretionary accruals, which is leading to the investor expectation. Uh, Also, there is a lower risk of litigation, which is there in the Indian context, and as a result, the promoters are involved in conducting these practices. This is the literature related to the how the earnings management in the past has actually been perceived by the stock market. This is the literature related to the stock trading and the corporate governance. I'm skipping it for. So now I come to the data part. So we have hand collected data from the NSE website. We have collected data from the period 2011-12 to the 2019-20. This why we selected this period, because there was no information related to the this surveillance action prior to this period. And then after performing our required data elimination, we did our required data elimination, and to examine the association of earnings management and the corporate governance, we have combined our data with all the firms which were listed on the NSE by 30th March 2020, because in the interest of the COVID period. And at that point of time, a total of 179 firms were listed. The financial data we have taken from the CMI ProS DX, which is actually a well-known data set in the cases of the India. And after performing the required data elimination, we have a 8,293 firm year observation, where we have 3,072 firms where the related firm has received at least one time notices for the clarification from the stock exchange, and which actually resulted to the 464 unique firms. So this is the overall broad model of conducting the hypothesis. So here, this is sort of a predictive model. We have taken the binomial panel logic model, where the main variable of interest is the discretionary accrual in the prior year period. This discretionary accrual is well established in the in studies as a measure of the earnings management. So this predictive model is actually saying that the earnings management in the prior year period leads to the likelihood of receiving notices in the next period. And we have put a set of the financial control variables like market to book ratio, cash flow from operation, and a set of the corporate governance variable as a control measure. For examining the association of the corporate governance and the likelihood of the firm receiving notices, we have used this model, where we have used a set of the variables are the institutional ownership, board size, whether the firm has a CEO duality or not, or whether the firm is audited by the Big Four, and what is the percentage of the independent director. for computation of the cumulative abnormal return, we just want to have a look at whether how the stock markets react to this particular surveillance notices given to a firm. We have used two methods. We have used size adjusted abnormal return and a CAPM single factor model. For the CAPM single factor model, we have taken the market factor from the Pharma French 4-factor model. So this is our result. So we actually could see that there is a positive association of the discretionary accrual in the prior year period to the dependent variable, which is the probability of receiving notice in the next year period. This is the result related to the our second hypothesis, which we suggest that if we are saying if there is an improvement in the corporate governance characteristic, like there is a board size, that CEO duality, or if the firm is audited by the Big Four, then there is a lower likelihood of getting the surveillance notice from the exchange. And this is the graph from the cumulative abnormal return from the period -10 to +10, where the day 0 is actually does suggest that the day at which the NSE has sent the notice to the firm. So if we see the graph, this is
15 minutes are over. You have to wind up within 2 minutes.
Okay, so I'm also done. So this is a cumulative abnormal return. We see there is after the firm received the notice, there is a decrease in the cumulative abnormal return. So to conclude that, we say that the firms which face the surveillance action are engaged in earnings management than the firms which do not face the surveillance action. We also highlight that if there is a poor corporate governance in a firm, then it has a higher likelihood of receiving the notices from the exchange. Our study also suggests that if a firm has an institutional ownership, its probability of facing surveillance action will decrease by 20%. With this, this is just one of the graph I would like you to show that these were some of the firm. These are the count of the firm and number of notices which were sent by the exchange to the various firm. With this, I conclude my paper. Thank you. I'm actually done. Thank you, sir.
Thank you.
Now you have to now discuss and can.
Yeah, now discuss. Jatin. So I will now request Dr. Jatin to offer his comments.
Okay. Dr. Ms. Bharti Singh, I have gone through this paper and some details which I have extracted. So first and foremost, I have seen paper very differently, considering the two important parts. First part is that this paper also demonstrates that how just a simple tool can come up with some very much robust outcome. So the way you have used cumulative abnormal return model and with its prediction, it's really very interesting, which it came up with a very robust outcome. When we compare the same thing with the other autoregressive modeling, so compared to that, I think the use of CAR is going to be best fit.
Yeah. Yes, sir.
In the part which you have mentioned in the introduction, so I'm referring to some of the part that since the work focuses on one surveillance action by NSE, which we can say that graded surveillance measures, or maybe we can say additional surveillance measure, ASM or GSM. Considering the rules which are being defined in GSM and ASM, you know that there are a series of rules which is being posted there. This surveillance action is initiated in the event of an abnormal function in price or volume. Right? The surveillance action which is being examined in this study doesn't specify the rule which makes the study different of earlier studies which have been examined surveillance action.
Yes, sir.
And based on this, I found two questions. Question first is that whether authors have considered all the rules provided by the NSE for the surveillance section.
Sir, in the Indian context, there are actually I came across only two of the papers related to the surveillance measure, which is one of the paper of the GSM of Nidhi Agarwal, and second one of the ASM, Additional Surveillance Measure, which was authored by, I guess, Professor Lata, but it is not actually made publicly available. So these are only the two papers in the Indian context related to the surveillance, and hence on the basis of that, I actually put that sentence that yes, how my study is different from the surveillance measures which have been addressed. And the thing is that in the case of the GSM as well as ASM, they have actually put it into the public that these are the criteria, that whether the market capitalization of the firm or P by E ratio of the firm is actually below the certain benchmark, or as a result, they will put the firm under the GSM or ASM categories. In this case, the NSE does nowhere actually discloses that what is their definition of their abnormal price increase or decrease. Should they call exceeding the price band as an abnormal price increase or decrease? So that is why I take it as a different from the rule-based surveillance measure. That was my concern. That was my opinion.
How abnormal events, particularly by the firms, are being considered?
How abnormal events by the firm are
being considered for the study?
So, sir, I am not talking about abnormal events, all types of the abnormal events. In this study, I am talking about the abnormal increase or decrease in the price or volume, and as a result of which the stock exchange sends the notices to the firm, asking an explanation for them that why we are witnessing this kind of the reaction from the stock market participant. So based on that abnormal increase or price decrease, I am actually building upon this building upon my hypothesis that this surveillance action is related to the earnings management and the corporate governance.
The last point which I wanted to mention, that during the study you have captured the details of firm which are being listed between financial year 11-12 to financial year 19-20.
Yeah, yes, sir.
That is only on National Stock Exchange.
Yes, sir.
The discussion which I referred, where I found particularly you mentioned specifically in literature review that surveillance action and earning management, where primary focus is on practice of an Indian accounting standards, right? And maybe you can say IFRS. So the question is whether the authors have considered practice of such accounting by NSE listed firms in terms of IAS or USGF.
So, sir, can I have your last point again? Can the authors? I could not hear it properly.
Okay. My question is whether the authors have considered practice of such accounting by NSE listed firms in terms of Indian accounting standard or GAAP.
So, sir, we have taken the data from the this Ind AS has actually come into being in the year 2015, and we have taken the data from the 2011-12 to 2019-20. So, we actually so whatever the data source we have referred to, that is the CMIE ProS database, it actually follows the IGAP. It actually follows the GAAP standard, that is the US GAAP standard. So, and in AS, what you are talking about is more related to the IFRS. So, as a result, we haven't actually put focus on the accounting practices, because the whole of the data set follows the GAAP procedure, generally accepted accounting principle, the US GAAP procedure, whatever the CMI ProS database from where we have extracted, that it follows only that form of the accounting rule, and hence as of now we haven't actually differentiated between the accounting rule followed by the firm.
Earning management, yes, correct. Earning management and corporate governance is really a very, very broad area. In fact, you can come up with the another relevant study in the same topic, considering the event, maybe you can go with the event study as and when, for example, the farm is being identified under any of the screener or surveillance by NSC. At that time, you can go with the specific event data, whether it is also impacting, whether shareholders, those who are holding the script for that company, are also paying the cost of any such mistakes which is being identified the NSC during the due course. So that also can be one of the study which may you can lead on.
Okay, sir. Okay.
Yeah, that is it from my side.
Okay, sir. Thank you, sir.
Any question?
Any questions?
Anyone? Can you explain this DSC variable?
Yes, sir. So, sir, wait a second. So, sir, DSC variable is the discretionary accrual model. So, it is actually well established in the literature that it actually derives from the Jones 1991 model. So here actually
how you have captured that?
Yeah. So the Jones model is actually first of all, we compute the total accruals of the firm, and from the total accruals, we subtract the non-discretionary accrual part of the firm. So whatever the difference between the total accrual and the non-discretionary accrual part, this is called as the discretionary accrual, discretionary component by the management. So the total accrual is actually is based upon the revenue and the property, plant, equipment, and non-discretionary accrual part is also based upon that particular component. But the total, using the econometric model, the difference between the two, we take it as a discretionary accrual component.
How do you separate these two?
So this is a residual value between the total accruals and the non-discretionary accruals.
Residual will come once you have the non-discretionary, isn't it?
Yeah.
So how do you determine non-discretionary? Suppose a balance sheet is given, how do you determine discretionary and non-discretionary?
So, sir, in case of, we actually estimate a regression equation. So from the coefficient of the regression equation, we compute the non-discretionary from the coefficient of the regression equation on the receivables and the gross property, plant, and equipment. Using the same coefficient, we actually compute the non-discretionary accrual parts, and then we actually subtract the total.
I am not convinced. A balance sheet is given or a CMI data is given.
Yes,
how do you differentiate discretionary part and non-discretionary part?
Sir, visually we can't actually say that this is the discretionary component and this is a non-discretionary component. We must have to go through the econometric procedure to compute the discretionary part.
So what is the equation for that econometric computation?
So for the total accruals, it is total accruals is computed as this is the dependent variable, which is computed as profit after tax. There's a difference between the difference is taken from the profit after tax from the cash flow of operation, and this is regressed to from
regressed against, then what you will get? Cash flow and the PAT. So where is the non-discretionary part?
Sir,
Okay.
I apologize if not able to explain, but so from this regression equation, whatever the coefficients do come for the independent variables, we take the same coefficients to once again compute the non-discretionary accruals, where the independent variable changes from there is a scaled difference between the revenue and the receivable parts. So actually, I'm not able to.
Non-discretionary can't be based on the statistical measure. Anyway, we'll discuss it sometime later. Yeah, thank you, Ms. Bharti Singh, and thank you, Dr. Jatin, for this comment.
Thank you, sir. Thank you, sir.
Thank you, and all the best.
Thank you, sir. Thank you.
You have already had your defense, or?
No, sir. I do have 2 more papers in pipeline, so I have it. Yeah.
Thank you, ma'am.
Thank you, sir. Thank you.
I now request another paper presenter.
It is also online.
Yeah.
So I request the second. Sreelakshmi R. Sabuj Kumar Mandal. Sreelakshmi R and Sabuj Kumar Mandal, you can present your presentation now. Sreelakshmi R.
Sreelakshmi.
Yeah, I'm here. Am I audible?
Yeah.
Yeah, to share the presentation, I have not got the link yet.
You can just go with the share.
Okay, sir. Yeah.
It's fine.
Sir, is this visible?
Fine.
Yeah. A warm good afternoon to all the dignitaries present. I'm Sreelakshmi, and today I would be sharing some insights on my work, dynamic connectedness and directional spillovers between the oil shocks and the Indian equity market, a time frequency approach. So the brief outline is background and motivation, then literature review, the research gap, variables of interest, the methodology, results, network analysis, and the findings in conclusion. So the oil prices stock market relationship has been a long researched one, owing to the importance of oil, that it is the lifeblood of the economy and industry alike. So there has a rich literature on that. So theoretically, oil price affects the stock markets via the production and consumption or investment channels. So from the production side, when there is an increase in oil price, there will be increase in cost of production, which will push the profits down and makes the stocks less attractive. Similarly, when there is an oil price increase, there will be an increase in the general price level and inflation rises, and as a result of which interest rates will be risen, because of which this investments become less lucrative in the stocks. So these are the channels by which the oil price passes through to the stock markets generally. And in the recent past, we can see that the oil prices are exceedingly fluctuating, and it has been nearly $20 per barrel in 1980s, and it has spurted to its highest around global financial crisis in 2008, again to nosedive in the next year, and again pick up during 2014, and again in the last April 2020, it has entered into an active range. So the oil price fluctuations are exceeding these days, and the effect or the impact of the oil price fluctuations on the economies are more pronounced now due to the increased global financial integration and the inimical pass-through of the information across the markets, intensifying the contagion effect. And as a result of this, we experience recurring irrational speculative bubbles. And this is a general condition. And coming to India, the case of India is more intriguing, as India is the world's third largest oil consumer, next only to US and China. And its oil import bill is very high, which exceeds more than 1/3 of its total import basket. And given that the equity market is at a nascent or evolving stage with a lot of noise traders, the case of India becomes more interesting to study. Here is a brief literature review. There is a rich literature review in the concerning the oil prices and the stock markets. So these are the seminal studies which are listed in the first paragraph. Similarly, there are so many studies which have tried to understand the impact, the direction, and the impact of oil prices on the stocks. So some of the studies have yielded positive, significant impacts, like Shenethal 1986, and these following ones. And also a few studies have yielded significant negative effects, and like Siner 2001, Bashir and Sadowski 2006. And few studies have found that there are no significant relation, and also there are few studies which have found mixed results. So as a result of which, there needs to be more and more studies taking into consideration more nuanced factors to find out why there is an ambiguity. Until 2009, we see that oil price shocks were considered as a very single entity, as in the underlying assumption was that the major part of oil shocks come from the supply side and the supply disruptions only, which is not the case. It was only in 2009 that Killian improvised a methodology to differentiate or disentangle the oil price shocks into the supply demand, overall demand, and the specific oil demand shocks. And as a result of which, we could see which source of the shock is impacting the stocks in a better way. So that was on a monthly frequency, and late in 2018, Reddy devised a new methodology which helps in the construction of oil shocks on a daily frequency. So the construction of oil shocks form a very important component while studying the relationship between the oil price shocks and the stock market, because the nature of the shocks actually matter to identify the impact. Now, the research gap that we observe is that mainly it is most of the studies that happen in this area even after 2009 using the decomposed oil shocks, it mainly happens using the monthly frequency data. But stock market is highly volatile, and any new information or news is usually incorporated into the prices fast, which makes it very unpredictable. So it's important to study the stock markets in a daily frequency framework. So there needs to be studies more on the daily frequency. Also, most of the studies we see are pertaining to the developed markets, especially US and Chinese studies. But there are actually, it's the emerging market economies that bear the brunt of the oil price fluctuations because of their high oil demand and dependency on the oil. But there is scanty literature pertaining to these emerging market economies. Also, there are very few sectoral level analysis. When you're taking the aggregate stock index, the cross-country studies take the aggregate stock index and study the relationship. But in that case, different sectors react different to the oil price fluctuation. So as a result of which, the heterogeneity, industry level heterogeneity, get masked in the process. So a sectoral level analysis is very important to understand the impact of oil price shocks on the different sectors and the economy. We also see that there is not many studies in the area happening which explores the connectedness, which is actually a prerequisite before we study the magnitude and the extent of the relationship between the variables. So here we would want to go for the Barunik and Kralik 2018 methodology of time frequency approach, which studies the relationship between the oil shocks and the stock market sectoral equities in three different horizons: the short term, medium term, and the long term. We also try to examine the spillover patterns during the entire time span, which spans from 2005 to 2021, which includes many major changes, including the major crisis of global financial crisis 2008 and the COVID-19 pandemic. So these are the variables of interest. For supply shocks, we proxy it using the returns of NYMEX light sweet crude oil futures prices. So futures prices are helpful in understanding the current supply statistics and also the expected demand for oil. Demand shocks are proxied by the returns of ARCA oil index, which is an index of the oil producing companies, and the risk shocks are proxied by innovations to the volatility index. Sectoral returns are log transformed returns of sectoral prices. So these are the variables used from the 2005 to 2021. So coming to the methodology, we actually follow a two-step procedure. The first one is we take the variables which proxy for the supply, demand, and risk shocks, and we try to run a structural war to extract the observed variables. So the matrix A actually identifies the shocks, identifies shocks into observable variables. So that is, it shows that the supply shocks have all the components together, and the risk shocks has only the risk component in it. And to impose the orthogonality, we have the equation there. So sigma X is the covariance matrix, and sigma square S, D, and V are the respective volatilities of the shocks. So after we extract the 3 observable shocks and the 12 sectoral returns, we actually follow the time frequency approach given by Barunik and Kralik, which is an extension of Diebold and Ilmaz. So the methodology is important, like it follows the identification scheme followed by patient mention, and it accounts for the frequencies of the responses rather than the impulse responses alone. It takes into consideration the responses over time scales over period of time, and basically we try to get the generalized forecast error variance decomposition of a variable into components attributable to the different variables in the system. How much of the variance of one variable is affecting other variables in the system. So this is the total connectedness equation. Also, the total connectedness of the system in the short, medium, and long term, along with the two spillovers and from spillovers, and the net spillovers is taken. So this is the summary statistics. We have 12 sectoral indices and 3 oil shocks. So IT sector has the largest mean and telecom the lowest, and demand shocks, among the oil shocks, demand shocks have the highest and risk shocks the lowest. And the fluctuation wise, metals, telecom and finance are highly fluctuating, while FMCG and health are the least fluctuating. So we also see that all the sectors except telecom is negatively skewed. Then moving on to the actual results of static connectedness. And this is the connectedness of the system in the short term. Short term is actually 5 days, which is 1 week in the stock market. So this is the connectedness in the short term. As we see that the total connectedness is 60.08%, which simply means that 60.08% of the total variation in the variables is coming from the variance from other variables in the system itself. So here are the 12 sectors and the 3 shocks. So in the short term, the largest transmitters are basic materials, consumer discretionary goods and services, followed by the industrial sector.
You can wind up within 2 minutes now.
So I will summarize it at the end. So this is the connectedness in the medium term. The total connectedness is 12.11%, which is very low compared to the short term, and the long term it is 4.39%. So these are the net spillovers. So we see that the sectors FMCG, health, IT and telecom are the sectors which are net receivers across all the horizons, and supply shock is also a net receiver across all the horizon. Others are all net transmitters of the spillovers. Now, spillover reception or the receiving of spillovers, among the sectors, highest reception is for basic materials, finance, followed by consumer durables, consumer discretionary items and industrials in the medium and long term, and least reception for health, IT, telecom, and FMCG. And in the transmission, highest for basic materials and consumer discretionary items, followed by power sector and metals. Again, least transmission is attributable to IT, FMCG, and health. Dynamic spillovers, we observe that the blue color indicates the short-term spillovers, green the medium term, and yellow the long term. So spillovers are highest in the short term, that is 85%, and falls drastically to 25% in medium term and 5% in long term. So if we see the period of the global financial crisis, we observe that there is a sustained increase in the spillovers for before and after the crisis. And in the COVID-19, we see that there's a sudden spike and then there is a slight variation. So generally, when we observe, we see that the quantum of spillover show a tendency to spurt during times of extreme turmoil, especially in 2008, 2011, 12, the Euro crisis, then 2016 shale revolution, 2020 COVID-19 pandemic, and so on. We have also examined the contribution of each shock to the system, each shock's contribution in terms of spillovers to the entire system. We find that in the short term, the supply shocks are more dominating. It contributes more to the spillovers in the short term. And especially we see the difference that during the global financial crisis, supply shocks are more prominent, while in the COVID-19 pandemic period, risk shock is more prominent, showing the effect of uncertainty on the spillovers. In the medium and long-term contribution,
sorry to interrupt, your time is over.
How much is left?
So 1 more minute, I'll just try to wind up.
Yeah.
Thank you. In the short term, long term and medium term, it's more or less similar, but demand shocks are taking a predominance over the other two shocks. And the network analysis also like a robustness check, which proves that the results that we got earlier are similar. So the green ones are the net transmitters and the red ones are the net receivers. And the spillovers drastically reduce in the medium term and the long term. And this is the general finding. So the total connectedness is highest in the short term, while it falls drastically in the lower frequency bands, be it medium term or long term. Similarly, spillover strength is also highest in the short term, while it falls drastically in the lower frequency bands. And among the oil shocks, we see that oil demand shock is the major spillover transmitter across all the time horizons, followed by the risk shocks. And oil supply shock is a net receiver in all the frequency bands. So among the sectors, the basic materials and finance have the highest reception, or they are receiving the most spillovers in the short term band, which is taken up by consumer discretionary items and industrials in the medium and long term. So FMCG, health, telecom, and IT are the sectors that have least reception in all the bands. They're more or less passive, and that make them apt for investments during periods of extreme oil swings. And dynamic connectedness analysis also reveals that the spillovers have a tendency to shoot up during times of extreme oil fluctuation, that also depending upon the nature of the shocks. So we believe that the results provide cues to the retail investors on designing a risk balanced portfolio, and also for the policymakers to take appropriate action depending upon the time scale of operation. Thank you, sir.
Now I request Jatin sir to give his remarks.
Yeah, Sreelakshmi, one simple question. How your results may differ in case if you have incorporated today's price change in your research?
Sir, can you repeat the question? Sorry.
My question is that suppose you might have incorporated today's price change, right? I think you are very much aware that what are the changes happening in crude oil prices. So what would be the difference in your study if you have incorporated prices till today?
Sir, actually, the stock market is, in one of our previous studies, we have found that the stock market is, no matter what the fluctuations in the oil price or other macroeconomic variables, the risk factor is playing a very important role in guiding the stock market, especially after the COVID-19 period, when a lot of retail investors are entering into the market. So I think when I include these things, recent changes or whatever, so the risk element would be very high, and we would see that the risk shocks are dominating the results.
You have used some part of regression, right?
Yes, sir. Methodological part.
Yeah, methodological part. So you have used correlation property also to find out the relationship between different asset prices. And I have seen in your result that there are very strong correlation we can establish between two different parts. So the question is that if there are really a strong association between all these independent properties, right, then don't you think there may be a multicollinearity issue?
Sir, the correlation is not very high, as like I have might not have put the correlation heat map in the presentation, but the correlation is not very high, but just we are trying to that is the reason why we are not trying to study the impact of one shock on these returns, but we are just trying to understand the connectedness, how each one is connected. So I think in that regard it won't be a problem, because we are trying to understand the spillovers from one to the other, like both bidirectional, and the strength of the connectedness.
Okay, all right. No question from my side, sir.
Thank you, sir.
Any questions?
Do we have any questions from online participants?
Thank you, Sreelakshmi.
Yeah. Thank you.
Thank you.
Thank you, Sreelakshmi.
Thank you for your questions. Thank you, sir.
Is there anything on the chat?
No. So now I request Ziya, Batul, come on.
नहीं दिख रहा है कुछ नहीं दिख रहा है हाँ it's okay हाँ yes
Yeah, good afternoon, everyone. My topic of presentation is dependency of Islamic and conventional stock market during COVID-19. As we all know that over the few decades, Islamic finance has seen an astonishing increase in growth. The major contributor to the growth of Islamic stock is Sukuk. Sukuk is just similar, is a financial certificate which is just similar to bond that in Western finance that complies with Islamic Sharia law, that is, and it is totally free from interest, that is riba. It includes direct ownership. It is currently offered in more than 60 nations and more than 300 monetary establishments. Islamic finance also developed as dynamic instrument for diversified portfolio and appealing conventional as well as Muslim investors in various nations. The principal reason motivated me for this research is to observe the dependency structure among global Islamic and conventional index. In 2014, Hamid also analyzed the dependency of conventional Islamic equity indices. It encountered an appropriate asymmetric dependency among these stock markets by using the Copula function. Copula approach is used to find out the modeling of dependency patterns and gives the greater resilience to permit the marginal distribution of dependency structure. In this paper, we studied three global Islamic index, that is MSCI Europe Islamic Index, MSCI US Islamic Index, and MSCI Asia Islamic Index, and three global conventional index, that is MSCI Europe, MSCI US, and MSCI Asia. So here I try to highlight the conditionally and utmost dependency among these three global index, Islamic index, and three conventional indexes. Now, this is the literature review of the study. For this purpose, I have gone through several papers, but here I am showing only, I have tried to show only those which are recently published and related to the dependency and relationship between Islamic and conventional stocks. Most of the outcome of these studies are related that the Islamic stock performed better than conventional stocks during crisis. According to this literature also, Islamic index perform better and it provides a safe haven for investors as well as Muslim investors or as well as conventional investors. Now, the research gap of my study is to present a different approach which includes dependency of global Islamic and conventional index by using Copula function. Now, the objective of my study is to the dependency of global Islamic index and global conventional index, including Asian nations. Now, the research methodology includes the data consists daily returns of 6 indices, that is European Islamic, European conventional, Asian Islamic, Asian conventional, US Islamic, and US conventional. The data obtained for the period of 29th November 2019 to 29th November 2021. I am taking November as a period of COVID-19 because in November, WHO declares COVID-19 as pandemic. So data source is MSCI database, and I have used the methodology that is Ziya Copula approach. Now this is the result of unit root test. Unit root test is used to check the hydrosity in time series. According to this table, there is no sequence is static at concentration, allowing null hypothesis due to the existence of unit root test. The null hypothesis is rejected at 5% level at first difference. Now, this is the descriptive stat of this study. According to the descriptive stat, the outcome specifies that the Islamic return is positive. Compared to the conventional stock market, the average return for conventional stock is comparatively high in context to Islamic returns. So here, cortesis is more than 17, which shows the distribution of all stock returns has tails, while maximum return is high in case of Islamic stock market. The return volatility in case of conventional stock is more, even though least in Islamic market. So according to the descriptive stat of this study, it also suggests that Islamic finance or Islamic stock is more safer than conventional stocks. And now this is the Ziya Copula approach. This figure represents the Candlestone method. Candlestone method is effective and used to check the goodness of fit degree in Copula function. It is high when there is similarity between two variables, and it is low when there is dissimilarities between two variables. According to this, the European Islamic Index was used to be the first node on the first Ziya tree, that is EIR. European Islamic Index is represented by EIR. Then I am used UIS, that is US Islamic Index, then AIS, then ER, UR, and then AR. According to this, AIS, that is Asian Islamic Index, is higher degree of dependency in comparison of other. It is a 0.62, 0.60, and 0.79. So, according to this, Asian Islamic Index is highest dependency with other variables, and here it is assumed that student T Copula could possibly allocate finance with exchange dependency of every set of indices. Now, this is the estimated Copula parameters. Here, Copula is introduced by the Scalar's theorem. It is helpful to capture the dependency of variables, various variable distributions. And in my study, I have used varied family of Copula with unique dependency structure. Student T Copula states with same higher and shorter tail dependency. Rotated Platon states higher tail dependency, and mixed Copula with asymmetrical dependency. Here, according to BV7 Copula results, once the market is sliding down, the probability of Islamic index is also sliding in downward situation. When the market is rising, Islamic stock is also in rising trend. So it is suggests that Islamic index and conventional index have exceptionally low and high tail dependency. The dependency between the Islamic and conventional stock is strong when market is in downward during COVID-19 period. So according to this table, student in Copula explained as the best method to define the dependency among Islamic index and conventional index. The mixed Copula function does not act as a fit as same to, because there is the absence of intense dependency at both the ends. So according to the Copula parameters also, it is shown that Islamic index is react as a safe product or as a safe haven for the investors. Now the findings and conclusion. The findings propose an adverse and statistically substantial effect of COVID-19 on both stock indices performance, because during COVID-19, Islamic as well as conventional stocks, they both are downward and upward according to the situation. The dependency for global conventional and Islamic index retained lower than the dependency during the pandemic. The student in Copula provides a finance split for every set of conventional and Islamic index. The Islamic index couples with conventional index and their average dependency is optimistic. The findings recommend that the existence of variation present in Islamic index does not strongly affect the Islamic index throughout the COVID-19. We find that sign of tail dependency among Islamic and conventional index in Asia and US, but not in Europe during crisis time. So, according to the tail dependency, investor of Asia and US includes involve the Islamic finance product in their portfolio to diversify the risk, and they have to diversify their risk due to the risky movement of market. This study also significant tail dependency among both the indices, in both positive and negative market conditions. It shows the limited dependency in Islamic index. In optimistic situation, symmetrical tail dependency is shown when optimistic market condition rises, the conventional index has a propensity to rise, and once the optimistic market condition declines, the conventional index usually declines. So it is suggests that decline in index value can have a higher impact on traders than decline in rate during the COVID-19 period. So in last, the result index that indicates that Islamic index is a secure refuge related to conventional indices. So according to this, the undesirable pandemic effect on the financial market is comparatively less mean for the Islamic index, because Islamic index is free from interest, and it is totally depend on the sharing of profit and loss. So this paper also underwrite to present literature of COVID-19, and this research extends existing literature on the pandemic and opens avenues for further research with other Islamic or other conventional indexes also. Thank you, sir.
That's it?
Yes.
Okay. Ziya, right?
Yes, sir.
Okay, Ziya. First thing I must mention that you really need some serious proofreading with this paper, because the number of grammatical errors and
yes, sir, I have sent the updated paper already by some other author. मतलब जो मेरे author से उन्होंने send किया हुआ है.
Okay.
Yes, sir.
But we have to go through this paper only.
Okay.
Right. We never had that opportunity to look at that revised paper. Okay. The question is that can you use this Copula method with the normal distribution?
Yes, sir.
Then why you prioritize student tree distribution?
Sir, because tree distribution is provide the finest fit for the tail dependency.
Okay.
So
since you found that there are all the skewed returns, considering that skewness, you have adopted for student tree distribution.
Yes, sir.
But have you measured that with the normal distribution?
No, sir. I have used a T distribution in Copula function only, and but skewness is descriptive stat only.
Okay.
Yeah.
And what about the Skylar's theorem? How you correlated from one part to another part? How?
So Skylar's theorem, Copula is introduced by the Skylar's theorem, and we use the Copula for check the dependency among two variables or more than two variables, and we can check the dependency by a linear correlation also. But here I am using the Copula function to check the best fit of tail dependency also. So
have you tested, for example, Skylar C with the F?
No, sir.
In most of the cases, whenever you find any of the relevance between this conventional market and mostly all these small market are always correlated, you always find the alternate market always do better.
Yes, sir, because I have taken the alternative market as Islamic market because it is totally from riba or interest, and it provides, it gives only the risk of profit and loss only, not some other losses. That is why Asia and US investors take Islamic products in their portfolio.
Whether this study adds value in informational efficacy?
Yes, sir.
Whether this study adds value in any information efficiency?
Yes, sir.
And how that?
Sir, it opens the options for Islamic stocks. So, investors, mainly Indian conventional investors may use Islamic products in their portfolio.
Very good. No further questions from my side. Sir.
So, Batul, I have some observations. See, you are saying that when the crisis period, this Islamic indices is performing better than the other indices. see, understand the construction of this Islamic indices. So it's not considering the banking stock. So any financial crisis or any crisis, the first severely hit is the banking sector. But if you see the post-crisis period, the very fast recovery is happening in the banking and financial sector. Even in 2008 crisis or even in this COVID-19 crisis. So only studying that period will not give you you can't say that only Islamic indices is better than that.
Sir, I have studied in a previous paper also regarding the oil crisis in 2008. Also, according to this study, Islamic stock is performed better than the conventional stock. On that study, I have taken the some sukuk indices, that is MENA sukuk, GCC sukuk, and Nifty Sharia.
Who are comparing the bond market versus equity market?
No, sir. Here I am considering the conventional index with the Islamic index.
Okay, next thing is that see, Sharia interpretation is different according to different law.
Yes, sir.
Okay, so Hanfi, Maliki, Hamli.
Yes, sir.
So in India, we have this TASIs which are governing this Sharia indices of BSc.
Yes, sir.
And different countries have their own interpretation as per that. Because see, if some stock you want to include as per the debt equity ratio, so different theology and different interpretation of that. So how can you comparing or making a standardization between the countries while selecting these indices? Have you gone through their construction methodology?
Sir, not very much.
Okay. So rather, who have floated this indices? Means MSCI, S&P?
Sir, MSCI.
Okay. On the MSCI?
Yes, sir. I'm on the basis of MSCI.
And
in this paper, I'm taking the indices of MSCI.
So what I will recommend you, so see, you see the downside risk. You are saying that the risk is low. So you see the downside risk. You calculate the Sharpe ratio, certainty ratio, efficiency ratio, information ratio, and then see that in the downside how it is performing with the conventional one.
Okay. Thank you, sir.
Shall we close or what is? Yeah.
Good afternoon, ladies and gentlemen. It is in such an honor to be a part of this wonderful event. On behalf of NISM and SEBI, I would like to extend my heartfelt gratitude to our esteemed paper presenters, chairs, discussants, and all the participants. I would also like to extend my sincere thanks to all the attendees and participants, both online and offline, for making the time to be with us and helping us make this event a grand success. Now I request Mr. Mandal to present a token of appreciation to our Honorable Chair Jinesh Panchali and Discussant Jatin Trivedi.